The following video is an extract from the Udemy course, Learn to Construct Financial Statements from the Ground Up. If you would like to purchase the full course, you can do so by using the link below. Hello and welcome back to this lesson where we'll be focusing on an area that can cause quite some confusion initially in terms of accounting for banking debits and credits from an accounting perspective, and then comparing that to your bank statements, debits and credits. So there can sometimes be some confusion in respect to the terminology. So we just want to do a session here on addressing that. So cash at bank, having a bank balance from a company's or an organization's perspective is an asset, and as set out in this table we've shown in terms of demonstrating the impact of debits and credits in various accounting categories. To increase an asset that is a debit, therefore from a bank's perspective, if they have got a positive cash position, or a bank position rather I should say, to increase that from a bank's perspective, you would debit bank. So for all purposes, a debit to the bank in an accounting perspective is a positive thing from the business's perspective. So as I've said, debiting the bank from an accounting perspective increases the bank balance in the books of the financial statements. However, when we contrast that to reviewing your own monthly bank statement from, say, your own bank branch, you would intuitively think that the credit column in the statement increases your bank balance. So when you're reviewing your own bank balance, say your own bank statements, from your own perspective, when your bank statement is credited, you would deem that to be an increase in your bank, in your own bank statement, and that's the same for a business. So if that's something you want to have a look at, by all means to do that. But that's something that is so widely known, and from when you receive your own bank statement, it's the credit column increases your own bank account. So what is the reason for the discrepancy between the accounting debit, in terms of a debit and accounting perspective, increasing your bank, and so contrast that to when you receive your bank statement from your own bank? The reason for this discrepancy is that you are receiving your bank statement from the bank's perspective. So we're just going to unpack that a little bit in this session, but first we'll just go through a bit of a recap on how banks effectively work. So a bank is a financial institution licensed to receive deposits and make loans. Banks provide credit opportunities for businesses and individuals. So individuals and entities deposit money with banks, and then the banks use that money then to lend that to others in the market in terms of loans or mortgages or leasing agreements. And this process creates liquidity in the market. So we are going to apply the debits and credits from the banking perspective and from a company's perspective, and we're actually going to pick up the transaction we just done in the previous video. So that transaction was a new entity was incorporated, XYZ Limited, and then the owner injected £20,000 of cash into that company's bank account. So we covered the debits and credits of that from XYZ's perspective, but we're going to look at now at both sides of the transaction. So we're going to look how the bank would present that in their books. We've already covered how XYZ Limited accounted for that in their own books, and we'll just do a recap on that just as a reminder. And then we're going to show you why there's this discrepancy between the accounting debit and then the bank statement you receive. So as I said, we're going to demonstrate the accounting from both perspectives, and we're just going to get to the bottom of why when you receive a bank statement, the credit increases your own bank balance. So from the bank institution, they received, in this instance where the money was lodged into the account, the bank institution actually receives £20,000 of cash that was lodged by the owner of XYZ Limited. So from the bank institution's perspective, they've received cash, and cash is an asset. In terms of the other side of that entity, I suppose XYZ Limited then can go and draw out that money at any time, so that is really payable on demand from the bank's perspective. So in effect, the bank institution actually owe that money to XYZ Limited, and that money can be drawn down by XYZ Limited at any time. So from that banking institution's perspective, that is a liability. So to go through the debits and credits of that, then from the bank's perspective, the bank would debit cash and then they would credit a liability to XYZ Limited, because if XYZ Limited goes to their hole in the wall or anything of that nature and wants to draw down that £20,000, they would have to do that. So the bank actually owes that money, and that money is payable on demand to XYZ Limited. Now, as a recap of how XYZ Limited would account for that, we've already done that in our previous workbook, Interactive Workbook 1. So we said the amount was lodged into the bank, so that is effectively an asset, because as I said, XYZ Limited can draw down that bank balance at any time, so that there's economic benefit to be derived from that. So that is an asset. And in terms of that asset, that was debit bank, and we covered that in the last video. And then in terms of the other side, when there's a transaction between an owner of the business and the business itself, it is reflected through equity. So as a recap, we had debited bank, and then we credited capital or equity from XYZ Limited's perspective. So that was the double entry we've gone through. So just to draw your attention to then, the bank have got a credit balance on their balance sheet owed to XYZ Limited. So just think how this is going to when you're receiving your bank statement from XYZ Limited, how that might look. So that is a credit from the XYZ's point of view. So in terms of XYZ Limited's point of view, you can see here XYZ Limited have a positive bank balance, and that is a credit, but again, that's a credit from the bank's perspective. So that is the little contrast between a credit in the bank statement perceived to be positive in this case, because this is £20,000 positive from XYZ's perspective. But remember, when we are doing the double entry for bank from XYZ's perspective, we had to debit bank because that is an accounting asset. So that's just the reason between that discrepancy. So XYZ Limited, so a bit of a recap here. XYZ Limited bank position in their accounts is a £20,000 debit to increase an asset in their account, in their own financial statements, because to increase an asset, you debit it. The bank statement is showing a £20,000 credit from because this is from the bank institution's point of view. The bank have an amount payable to XYZ Limited on demand, so it's a credit on the bank's balance sheet. So again, this is still holding true in terms of the accounting principles of debits and credits to recognise assets and liabilities. So this is just the reason for this discrepancy. So main takeaway, debiting the bank from an accounting's perspective increases the bank balance in the financial statements or the accounts of that entity. So hopefully I made that clear. So it's just working through the debits and credits there from both sides. Hopefully we'll clear up that one. So hopefully now that makes sense. We can now continue with our interactive workbooks. So I will see you over in the next lesson. Thank you.